What's going on, peeps? Your boy DK, aka Smooth Kid. Hope all is well out there. As you can see, we got us a beautiful day. Can't do too much complaining. Another day above the ground is always a blessing. But we're gonna get straight into it. Like I say, I hope all is well out there. But we got some interesting news going on right now. I'm gonna share my screen so we can see what Jerome Powell talking about, which is the chairman of the Fed, the guy Trump been trying to get fired. So let's see what he talking about right quick, man. Come back up. Mm-mm.
direction. AI could make more productive and push in the other direction. I don't know though. So both housing services and non-housing services have really been grinding down toward levels that are consistent with 2% inflation. So that's the good news. We've had goods inflation just moving up a bit, and of course we expect, as you point out, we do expect to see more of that over the course of the summer. It takes some time for tariffs to work their way through the chain of distribution to the end consumer. A good example of that would be goods being sold at retailers today may have been imported several months ago before tariffs were imposed. So we're beginning to see some effects, and we do expect to see more of them over coming months. We do also see price increases in some of the relevant categories like personal computers and audiovisual equipment and things like that are attributable to tariff increases. In addition, we look at surveys of businesses, and there are many of those, and you do see a range of things, but many companies do expect to put all or some or all of the effective tariffs through to the next person in the chain, and ultimately to the consumer. Today, the amount of the amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are as we learn more. And we think our policy stance is in a good place where we're well positioned to react to incoming developments.
So in terms of how we should interpret the rate cuts penciled into the SEP, is this reflecting that there's this expectation that underlying inflation will just stay well enough contained that allows the committee to eventually move ahead with those cuts? Or is it about, responding to a deterioration in economic activity, let's say? I mean, how should we make sense of the forecast?
So if you look at the forecast, you will see that people do generally expect inflation to move up and then to come back down. But we can't just assume that. Of course, we don't know that. And, our job is to make sure, one of our jobs is to make sure that a one-time increase in inflation doesn't turn into an inflation problem. And that, again, that will depend on the size of the effects, how long it takes for them to come in, and ultimately on keeping inflation expectations anchored.
Hi, and thanks, Chair Powell. Howard Schneider with Reuters. If you look at the rate path starting in December to today and adjust it over the full time horizon you've got there, you've taken about a quarter point per year out of your projected path, and you end at a higher rate at 2027 than you would have in the prior forecast. Is that a result of a sense that tariffs will lead to more persistent inflation? Is it a result of reassessments of where your short-term neutral rate is? Why are you on a slower path now?
The little slower growth, just a tiny tick up, a 1/10 tick up in unemployment, and you see inflation moving up 3/10. And by the way, it was a similar move from the December SEP to the March. So that's what you see. You see the effects of tariffs. I think we learned in April after the March meeting that substantially higher tariffs were likely, and then since then, the estimates of where the tariffs will be have actually moved back down, although still at an elevated level. So we're adapting in real time. And what you see is an accumulation of individual assessments.
You say in the statement that risks have diminished, on that front. But the July 9th, drop dead date for all the Liberation Day tariffs is still out there and unresolved. You've got now exchange of missiles between two Middle East adversaries with a possible U.S. involvement. How can you justify saying that risks have diminished?
So what we said was that uncertainty uncertainty about the economic outlook has diminished but remains elevated. Many surveys say that they do. So and that's actually a line from the Teal book, which you can see in 5 years. Remember to check that.
Maybe the world will do it.
No, but if you think about it, tariff uncertainty really peaked in April, and since then has come down. And that's really what that's just acknowledging. It's diminished, but still elevated. That it's uncertainty. So I think that's an accurate statement.
Thank you. Chris Rugaber at Associated Press. There is an argument out there in favor of cutting rates more immediately. Inflation has continued to cool and is back at roughly 2% despite the tariffs. And I guess I also wanted to ask about, cracks in the job market with gross hiring slowing, concentrated in just a few industries. We've seen some housing data, including this morning, that have been pretty weak. Do you see any concerns that the economy is weakening and that is a reason to cut rates going forward?
So we do of course monitor all those things. I think if you look at the overall picture, what you're seeing is 4.2% unemployment and an economy that's growing at a rate hard to know given the unusual flows in the first quarter, but it appears to be 1.5%, 2%, maybe a little better than that. Sentiment has come up off of its very low levels. It's still depressed. So you can point to things. The housing market is a longer run problem and also a short run problem. I don't think it's indicative of basically the situation is we have a longer run shortage of housing, and we also have high rates right now. I think the best thing we can do for the housing market is to restore price stability in a sustainable way and create a strong labor market. And that's the best thing we can do for the housing market. You asked about the job market. Again, look at labor force participation, look at wages, look at job creation. They're all at healthy levels now. I would say you can see perhaps a very, very slow continued cooling, but nothing that's troubling at this time. But we watch it very, very carefully. So overall, again, the current stance of monetary policy leaves us well positioned to respond in a timely way to economic developments, and for now, and we'll be watching the data carefully.
Well, just quickly on, given that there are concerns inflation will rise, but there is the alternate scenario that tariffs would create demand destruction and slow growth sufficiently, and that would perhaps keep a bit of a lid on inflation. Do you see odds of that scenario? What kind of odds do you see of that scenario coming true, and how many months of cool inflation would you need to see before concluding that maybe that lower inflation scenario is taking place? So
this is very much the conversation we had today and yesterday. There are many, many different scenarios, many combinations of scenarios where inflation does or doesn't prove out to be at the levels we think, and where the labor market does or doesn't soften. And I think what you see people doing is looking ahead at a time of very high uncertainty and writing down what they think the most likely case is. No one holds these rate paths with a great deal of conviction, and everyone would agree that they're all going to be data dependent, and that you can make a case for any of the rate paths, I think, that you see in the SEP. And we do this once a quarter. It's a hard thing to do particularly at this time, but it does reflect. If you see somebody writing down a rate path that involves cuts, that's them saying, yes, I think we will get to a place, more likely than not, where cuts will be appropriate. And it could be a joint probability of a number of possible outcomes. Again, remember how much uncertainty we face, though.
Thank you. Mr. Chair, I wonder if you could describe for us some of those scenarios. How do you get to a place? I'm noticing that the uncertainty levels in your forecast are very high. How do you get to a place where you have the confidence in the outlook for say, inflation and or growth or the unemployment rate, how many months does it take, and what do you want to see in the data to get to that level of confidence to actually reduce rates off the restrictive level?
So it's very, very hard to say when that will happen. We know that the time will come. It could come quickly. It could not come quickly. As long as the economy is solid, though, as long as we're seeing the kind of labor market that we have and reasonably decent growth and inflation moving down, we feel like the right thing to do is to be where we are, where our policy stance is, and just learn more. And in particular, we feel like we're going to learn a great deal more over the summer on tariffs. We hadn't expected them to show up much by now, and they haven't. And we will see to the extent to which they do over coming months. And I think that's going to inform our thinking, for one thing. In addition, we'll see how the labor market progresses. So at some point, it will become clear. I can't tell you exactly when that will be. And meanwhile, we'll be watching the labor market very carefully for signs of weakness and strength, and tariffs for signs of what's going to happen there. And of course, there are many developments ahead. Even in the near term, developments are expected on tariffs. So I think we don't yet know with any confidence where they will settle out. We have an estimate, and I think all estimates are now pretty close together, but it's again highly uncertain.
When you say estimate of the impact of tariffs on the core PCE, is that what it is? And could you share that?
What you start with is what's the effective tariff rate overall, and people are managing to that. But the pass through of tariffs to consumer price inflation is a whole process that's very uncertain. As you know, there are many parties in that chain. There's the manufacturer, the exporter, the importer, the retailer, and the consumer. And each one of those is going to be trying not to be the one to pay for the tariff. But together, they will all pay for it together, or maybe one party will pay it all. But that process is very hard to predict. And we haven't been through a situation like this. And I think we have to be humble about our ability to forecast it. So that's why we need to see some actual data to make better decisions. We'd like to get some more data. And again, in the meantime, we can do that because the economy remains in solid condition.
Nick Generoso, the Wall Street Journal. Chair Powell, I guess I'm wondering if you could explain a little bit more the divergence we see in the dot plot, particularly around the 2025 rate projections. I realize this is, you have one group of officials that are putting down no cuts, another that are putting down more than one. And again, recognizing that could be difficult to summarize, but is it a matter of people having a different outlook or a different reaction function, a different commitment to defending against another inflation mistake? How did that play out over the last 2 days?
So you're right. This is often the case. We have a pretty healthy diversity of views on the committee. We did have strong support for today's decision and broad agreement that our policy stance does leave us in a good place. But I would point to two factors, and you mentioned them. The first is just that parties have a diversity of forecasts, and they do align with where their dots are. So if you have a higher inflation forecast, you're going to be less likely to be writing down, more cuts. But remember, as we see more data, we're going to learn more about where inflation is headed, and that means when it is time to look at resuming our normalization process, the differences you see should be smaller because we'll have seen actual data. Right now, it's just a forecast in a very foggy time. So that's the first part, is forecast. Secondly, people can look at the same data and they can evaluate the risks differently, as you know. And that includes, the risk of higher inflation, the risk that it'll be more persistent, the risk that the labor market will weaken. People are going to have different assessments of that risk. So you put that in there too. So those are the two ways that the two things I think that drive these things. Remember though, as I mentioned earlier, with uncertainty as elevated as it is, no one holds these rate paths with a lot of conviction. So that's really where it is. It's a function of those things. And I think as the data come in, you should see those differences diminish.
If I could follow up, you've said the policy is in a good place and that it's modestly restrictive. Given all the uncertainty you just talked about, tariff levels, uncertainty around the pass-through, is it price increases versus margin compression, some of the softness that Chris talked about in labor and housing, why wouldn't it be better to have rates at a more neutral setting as the economy heads into this period of very high uncertainty?
So if you just look backward at the data, that's what you would say, but that's not. We have to be forward-looking, and the thing that every forecaster, every outside forecaster, and the Fed is saying is that we expect a meaningful amount of inflation to arrive in coming months, and we have to take that into account. So, I think a backward-looking look would lead you to a neutral stance, but we can't. We have to look at that, and because the economy is still solid, we can take the time to actually see what's going to happen. There's a range of possibilities on how large the inflation effects and the other effects are going to be. So we'll make smarter and better decisions if we just wait a couple of months or however long it takes to get a sense of really what is going to be the pass-through of inflation and what's going to be the effects on spending and on hiring and all those things.
Michael McKee from Bloomberg Radio and Television. Your friend down at 1600 Pennsylvania Avenue continues.
Try and explain to me how you can join a free community with 17,000 members and not learn something that will improve your trading.
Maybe carved out the Fed from some of the legal implications of that. Whether this is just noise that the markets and everybody should ignore until your term is up, or whether you worry that it could lead to more pressure on confidence on Wall Street, on consumers about the outlook for the economy.
Okay. From my standpoint, it's not complicated. What everyone on the FOMC wants is a good, solid American economy with strong labor market and price stability. That's what we want. We think our policy is well positioned right now to deliver that and to be able to respond in a timely way as the data lead us around. The economy's been resilient, and part of that is our stance. And again, we think we're in a good place on that to respond to significant economic developments. That's what matters. That is what matters to us. Pretty much that's all that matters to us.
I need to ask, assuming you are not reappointed, would you stay on as governor when your term as chair ends?
I'm not thinking about that. I'm thinking about this.
Andrew.
Thanks, Mr. Chairman. I guess with workplace raids picking up significantly, what kind of effect would that have on the labor market in the short
with
term?
what picking up?
Workplace raids.
So you're asking immigration?
Yeah.
I wouldn't want to speculate. One way to get at that from an economic standpoint, we of course don't comment on immigration policy. It's not ours to make or comment on. But what you see is an unemployment rate that has been really solid and at a low level, not really increasing. It's been in a good range and well within the range of mainstream estimates of maximum employment. And that means part of that is that labor demand and labor supply are kind of moving down at the same rate. Labor demand is softening. You see that in job creation, but it's still kind of at a healthy level. And labor supply is diminishing because the immigration numbers that we see are much lower than they were. So those two factors, supply and demand, that's what has kept the unemployment rate in a reasonably stable place.
Okay, thanks. The other thing I wanted to follow up on is if you could elaborate on the potential changes to the SCP that you suggested were part of the framework review, I think.
So the framework review really has two tracks, right? The first track is our policy framework that is reflected in the consensus statement. And we've said that we would finish that and announce it by the end of the summer. So we're well along in that process. We've had the meetings that we need to have, and we're now going to be going into, into discussions about, specific changes to language. So that's the framework part of it. The second part of it is our communications tools and practices. And that part comes next. Okay, that's what we're going to do in the meetings this fall. Actually, what we did at this meeting, though, is we sort of prepared the ground for that. We had a meeting where we talked at a high level about a number of ideas. The SCP is part of it. Many other ideas. It's sort of how do we think our communications can be improved? There are a number of ideas. People offered a really it was a great conversation, number of ideas, but we're going to look at those with staff briefing and a lot of thought in the fall. And I would say when it comes to changing communications, I would only support things really only implement things that have very broad support. And also you want to be really careful because I think our communications are pretty well received. They're not broken. So more is not necessarily better, but better is better. So we're going to be looking at ways to do things that will improve the clarity of what we do for the benefit of the public.
Okay, man. That was the Fed chairman, and basically what I'm getting from what he's saying is they still are expecting inflation going into the end of the year with all these tariffs and all these different EOs that Trump and them is signing. So pretty much in line with what I've been kind of preaching. This is just in a sense, pay attention, stay on top of what's going on. Might want to be a little bit more frugal right now. You ain't got to take that trip, or you ain't, it's something that just not necessarily you got to do. You might want to, kind of sit around and wait. But you got a lot going on. It could be more than enough for you to keep up with, from the different policies, the different laws, all of these things, the bills that's being signed, and they doing this on purpose, right? The purpose was to flood us with so much information that you can't keep up, right? You can't follow along, because at the end of the day, you still got to take care of your business. You still got to put food on the table. You still got to go to work. You still got to cater to your kids. You got needs. So we got all of these things being flushed into the system at one time. How could you just possibly keep up with that, right? So when you get in and you hear the Fed, who's a person he's neutral, right? He ain't on the Democrat side, he ain't on the Republican side. He all about that money. He all about that dollar. He all about the risk in the health of the economy. So when you hear somebody like him talking like what he's saying, they still expecting inflation. They got to see a little bit more data before they cut rates. They standing 10 toes on their policies, on what they believe in. So that's a good sign. 'Cause even though you got the president of the United States calling him out by name, saying he need to be fired, woo out the bam, bruh still holding, them as an organization, right? They still holding firm in their stance, because it's just not him. He's just basically the spokesman for the entire system when it comes to the Fed, who is basically, like I always say, they're like our landlords. They are the ones who are making sure the economy and things are going the way that it should be, because if not, they got to step in and pretty much control the monetary policies, or the narrative of the monetary policies, right? Like he was just saying in the question, he don't get involved in politics as far as the laws of the land, or they don't give a damn about how the government run the government, but they do care about the effects of how the government is ran. Bottom line, the numbers, what these numbers say, and based off these numbers, this is what they're going to enact, whether it's higher interest rate, lower interest rate, uh, all these different things that they have the ability to do. So when you hear somebody like that talking, man, take all of that into consideration, especially industries that can be affected by tariffs. I just seen on Bloomberg this morning, pull it up right now, and they're talking about GM profit just fell due to the tariffs. So when you got this type of situation going on, like he was saying, there's a lot of uncertainty. We don't know. We haven't let the time pass by enough to see the effects of these tariffs that been in place. Trump trying to, what they call, pull a fast one on you, right? Um, if I can go ahead on and get what I want in the beginning before the data actually come back, I could just keep kind of sliding and acting like what I've been running on as the president. I'm standing on it, and that's just not how it works, right? You gotta have checks and balances in place, no matter if you are the president. So then you got Bessie saying that he don't see no reason for power, and if you've been in this world, right, for the last couple of years, and you probably wouldn't see no reason for him to step down either. Especially somebody like who's been the Fed since COVID, having that experience to be able to lead the economy back out of that hole that we was in. You know, you got to get that man some credit on what he doing and how they do what they do. So pay attention to that, man. We definitely gonna be monitoring that real close at the next FOMC meeting. We're gonna see if they're gonna actually cut rates, or they gonna stay neutral. Hell, you never know; it might increase them because, like you said, we gotta wait and see about that inflation data that they themselves are expecting to be up. So if they saying it, why? Who am I? Right? Who are we to go against experts? You know, they see things in the backdrop that we don't see until the data actually becomes public. So, you know, I always like the power. He always, you know what I'm saying? Like I say, he always stood firm on what it was. So, and he give good answers when they ask him questions. He give good insight on why they doing what they do and what's to come after they do what they do. So I ain't got no problem with Powell either. You know, it's just being able to decipher through that lingo so you can get ahead of the curve, so you can get there early to what's going on. That's why I say so. If you looking at a particular company and you know that they input is based off, you know, their supply chain is based overseas, you might want to, you know, pay attention because if Trump continue to push these terrorist narrative, if he keeps standing tall on saying he gonna leave these tariffs in place, I mean, business 101 is the cost always get passed down to the consumer. So to not think that it's going to affect your business or us is just foolish. This ain't a myth. This ain't no conspiracy theory. These are facts. This is business 101. So just pay attention to that, man. He gave some good answers. I feel like we'll see how the market. It's just 9:06. The market ain't even been open an hour yet, so we'll see how the market factor in what he's saying. He probably still taking questions, but he answered a lot of the main questions, so we don't have to sit there and just watch the whole thing. So, oh yeah, we'll see how they play out. I was talking about yesterday. Um, we was talking about Google, Citigroup, and Delta as far as the stock options, man. I've been really getting into stock options as of late. I really been getting into stock options as of late. I like stock options. I like the way that they move. I like the way that they flow. Uh, and for me, somebody that's been in the game 5 years now with currencies and cryptocurrencies, I feel like it's only right, you know, to add something that's to my arsenal. The main thing with trade with options is just figuring out which option to choose. Having the eye to see what you see on the technical side, and then going off earnings, things like that on the fundamental side. Not that hard to predict if a stock is going to, you know, increase in value, right? The main thing is if you're going to trade options is making sure you select the right option, because um you got other factors that you have to take into account before you take that option. You know, with the different deltas, you know, like time decay, all of these things could help or hurt you if you don't select the right one. So that's the main thing with options. But I like options. I've been doing it consistently now for about 6 months, and nothing but positive results, right? Lessons too, for sure. Not all wins, but like I say, lessons. You learn a lot, and I like the potential in it. Right now, with everything that's going on out here in these streets, for us investing and trading, it's hard to just say, nah, man, I'm gonna leave that over there. Hell, nah, you leaving money on the table for sure. So, you know, not trying to be the jack of all trades, but I ain't trying to leave no paper on the table either, man. You shouldn't either. Gotta pay attention to what's going on, man. So, um, stocks for sure, man. We're gonna see how the market play out over the next couple of hours for sure.